There seems to be no end to the negative financial news these days. Some investors are predicting a bone-dry recession and a full-scale stock market crash. As a result of the interplay between the health crisis, Russian aggression in Ukraine, disrupted supply chains, skyrocketing inflation, increasing interest rates, and an unruly commodity market. Massive losses are being reported by the financial industry and the global economy as things get worse by the day. The only issue remaining is whether you will be on the side of those who prepared or if you will be lost in the turmoil when the collapse occurs. We hope this has been informative. A broad breakdown is on the horizon, and things might go off the rail sooner than most people believe. Due to the dismal status of the world economy and financial markets, as well as the impending significant slump, we have collated warnings, indicators, and current data released by Wall Street's leading analysts. Here are 10 financial statistics that simply might scare the living daylights out of you. But first, welcome to 360 Economist. Don't forget to leave a thumbs up and subscribe to our channel so you don't miss our future videos. 1. Business Insider reports that amid rising interest rates as the Fed begins to wind down its bond purchasing program, Wall Street has now issued its first formal warning about a recession and stock market meltdown. All of the top Wall Street banks anticipate a severe decrease in the coming months and through the year 2023. 2. On Tuesday, analysts at Deutsche Bank predicted that the S&P 500 would decline by an additional 20%, sending Wall Street into a bear market just before the U.S. economy entered a recession. The analysts predict that this opinion will eventually gain acceptance. 3. According to Morgan Stanley, this is already a bear market, and the most recent gains were a portion of the rally that usually precedes a bear market decline. Mike Wilson, the company's chief equity strategist, asserts that the bear market rally has ended and that as the economy slows, it is now time for a series of corrections. 4. In the meanwhile, Goldman Sachs experts anticipate a severe economic downturn in 2022. They anticipate that the GDP will fall from 5.7% last year to 1.9%. Additionally, this year, they noted there is a 35% possibility that the United States could have a recession in the next months. 5. In a note published on Friday, Bank of America's Michael Harnett stated that the inflation shock is getting worse. The strategist noted that while the rates shock is just getting started and a recession shock is imminent, some under-recognized factors such as food inflation protests in developing countries are likely to have a much greater financial impact on global growth than traders are currently pricing in for social instability in emerging markets to equal weaker growth. He wrote that inflation always precedes recessions, and that higher yields are the last domino to fall in terms of expectations for a recession. But a recession shock is also imminent. 6. The huge movements in the U.S. Treasury bond market last week is a major warning sign for the financial markets. The yield on the benchmark bond, the 10-year Treasury, increased by over a half percentage point in the first 4 months of 2022, from 1.5% to 2.55%. With rising interest rates and high inflation harming economic development, Investors are viewing this bond route as a warning sign of the next recession and stock market catastrophe. Now, according to historical patterns, this also suggests that a seismic shift is occurring. 7. William Dudley, a former head of the New York Fed, is quoted by Bloomberg as saying that the central bank will not be able to tackle inflation that's running at a 40-year high without making investors suffer. It's hard to know how much the US Federal Reserve will need to do to get inflation under control. To be effective, it'll have to inflate more losses on stock and bond investors than it has so far. Furthermore, he pointed out that the Fed isn't likely to intervene if financial markets see significant losses. 8. According to Business Insider's columnist Lynette Lopez, who spoke to top investors under the condition of anonymity so they could speak candidly about where the market is headed, a consensus has indeed emerged that the Russia and Ukraine conflict will cause widespread economic chaos and a bone-crushing recession throughout the world. 9. If you doubt it, look at the short seller index. In the past month alone, bets that the stock market will crash in 2022 rose 11 basis points, with some areas including consumer discretionary and energy stocks registering the biggest jump, in short positions rising by 74 and 72 basis points, respectively. Wealthy investors already know that a significant stock market crash is coming, and they have been monitoring their risks and taking defensive positions to prevent further losses. 10. The prognosis is also not promising on the opposite side of the world. China, one of the key forces driving global economic growth, is confronted with a number of financial and economic difficulties. The nation's residential and commercial real estate markets are being shocked by the failure of the country's largest property developer, Evergrande Real Estate Company. Up to 1/3 of China's GDP comes from the real estate sector, and with this crucial industry in disarray, the Chinese economy is deteriorating. Additionally, fresh viral outbreaks and lockdowns are having an adverse effect on the manufacture of commodities and international transportation, which is worsening the already existing supply chain emergency. The biggest financial crisis in modern history is just a matter of time, and given how quickly things are unraveling, it won't be long until we are in the heart of it. We appreciate your time and hope to see you in our future videos.